Welcome to the Roundup, where we'll explore what's important to accountants and advisors across the month of March. This month, of course, the federal budget dominates. This is an election budget, and with all pre-election budgets, it's soft on structure and strong on voter appeal. A large part of this was the cost of living initiatives. Now, the legislation enabling these initiatives was passed into Parliament and passed Parliament on the 30th of March. Michael, what can you tell us about it?
Yeah, that's correct. On the day after the budget was handed down, so on the 30th of March, the government introduced a bill to Parliament containing a number of the measures that were announced in the budget, and including some measures that were actually announced pre-budget as well. These are some of the measures, I guess, that the government is referring to as cost of living related measures, designed to help both individuals and businesses from a cash flow point of view, at least in the short term. There's quite a few things that are contained in that bill. Some of them include, for example, increases in the Medicare levy and surcharge income thresholds. We see that sort of thing happen kind of most years as part of the budget. There's a decrease in the GDP adjustment factor for PAYG instalments. That rate has been reduced from 10% to 2% for the 2023 income year, with the aim being that, particularly for smaller businesses, potentially there's a bit of a cash flow saving in the short term as a result of that measure. The bill also contains the increase in the low and middle income tax offset. For some people, that will go up by $420. The bill contains the $250 cost of living payment, which some people will get. Not everyone will get that, but some individuals will receive that. The much publicised 50% reduction in the excise rate for certain fuels is contained in that bill as well. And then the other thing just worth mentioning is the specific deduction that can now be claimed for COVID tests, to the extent that those tests are used to determine whether you can either attend or remain at work. Now, this was one that was announced quite a while ago. The government had announced that they would ensure that COVID tests would effectively be deductible to employees. And what the bill does is basically kind of ensure that. Now, some people have suggested we maybe didn't need extra legislation for this, that general deduction rules might have done the job. But this change does clarify the position. Basically, what it says is if you incur a cost as an individual on a PCR test or a rapid test, as long as it's kind of an approved test, and you are doing the test to determine whether you can attend or remain at a place where you conduct your income earning activities. Now, that could be as an employee or someone running a business. Then you should be able to claim a personal deduction for the cost of those tests. Now, when the government first announced this measure, they made a reference to people who might undertake a test in relation to remote working or working from home. I'm not quite sure how that comment kind of fits in with what's actually in the bill, in the legislation, and certainly what the EM says as well. Really, these rules are, from what I can see anyway, targeted at tests that are used to determine whether you can either go to a place where you'll earn your income or you can stay at a place where you are earning your income. I can't see any real scope to apply the deduction when you're doing a test on a day when you were going to be working from home anyway. I can't quite see how that fits together. The other thing that the government had noted originally when this announcement was made, that they would also make sure that the FBT rules worked so that employers who were providing tests or bearing the cost wouldn't have an FBT liability. It doesn't look like any legislative changes are made, but there are just some references in the EM to the fact that the otherwise deductible rule probably does the job here. By giving individuals a specific deduction for these costs, if the employer pays or reimburses those costs on behalf of an employee, presumably the otherwise deductible rule would kind of step in to eliminate the FBT liability there. Now, it is up to the individual to meet kind of basic substantiation rules around this. There are some slightly modified rules in terms of substantiation for employees, work-related expenses in this area. But really, as an individual, the expectation is that you're only claiming deductions for work-related COVID tests. If you're doing a test to determine whether you can go away on holidays or go and see your family or whatever the case might be, there's no expectation or intention that those costs are deductible. Now, determining compliance with this would be a bit of a headache for the ATO. So it remains to be seen exactly how they will go about testing this and checking in that people are only claiming what they're meant to claim. But of course, as we're discussing this with clients, we need to make sure that they are aware that there does need to be that connection with income producing activities. So that bill was introduced into Parliament the day after the budget night. It also passed through Parliament on the same day. So it went nice and quickly through the parliamentary process. It is awaiting royal assent to kind of get that formality around it before it becomes legislation. But it's pretty much there. So as I said, some of those budget measures and some earlier announcements made by government are pretty much now legislated, and we can pretty much operate on the basis that those things will come to pass.
Let's focus on the questions that clients will be asking about. Michael, what stood out for you?
Well, one of the things that stood out from the budget was the bonus deduction that the government is proposing for expenses relating to training of staff. The idea is that businesses that spend money on training their employees would be able to claim not only the normal deduction for those costs, but also get basically a 20% bonus deduction on top of that for expenses incurred from basically budget night until the end of the 2024 income year, so 30 June 2024. Slightly odd in terms of how the timing might work. What the government is suggesting is that costs that are incurred in the 2020 year, so from budget night up until 30 June 2022, what they're indicating is that the bonus deduction for that period of time for those costs would get pushed into the 2023 year. So it's a little while off until you actually get any cash flow benefit from claiming that deduction. It's still there, but it's just pushed down the road a little bit further. Whereas costs incurred in the 23 and 24 years would be claimed in the 23 or 24 tax return as the expenses are incurred. So you have some slightly odd timing rules potentially for that first period of time. But yeah, 20% bonus deduction. There doesn't seem to be any kind of annual limit on that bonus deduction. This measure is aimed at smaller businesses, so aggregated annual turnover of less than $50 million. And of course, it's subject to the passage of legislation. We need to wait and see whether this actually gets through Parliament. So that'll be obviously one of the big question marks that sits alongside this measure.
So what details aren't covered in the budget announcement that advisors will really want to know? Yeah,
I mean, as with lots of budget announcements, we're given a little bit of detail, but not much. So we are really waiting for the government to flesh this out for us. What the government has indicated is that this is really aimed at training of your own employees. So there's a suggestion that, if you had training costs relating to a contractor, that might not qualify. It needs to be training provided by an external organisation. So the government has suggested that in-house training, so the costs of running your own in-house training, wouldn't qualify. So you probably can't set aside some of the salary that's being paid to someone who's already within the organisation and attribute that to training and get the bonus deduction. Doesn't seem like that would work. The other thing we don't really know just yet is what are those training courses, or what does the education need to relate to? For example, does it need to relate closely to the employee's current income earning activities? Do we need to look at it in much the same way we do for claiming self-education costs? We'll wait and see. What gives me a little bit of hope in that area is that the government has quite recently passed legislation around some of the FBT rules around reskilling and training employees. So it may well be that a slightly broader approach is taken to this as well, but we simply don't have the detail on that. So that's probably one of the big things that is missing at this stage.
So a similar incentive is being provided for technology expenditure. How will that work?
Yeah, so the government has suggested that a similar mechanism will be used to encourage investment in new technology and digital adoption by businesses. So for smaller businesses with aggregated annual turnover under $50 million, a bonus 20% deduction is being offered for expenditure on upgrading technology and adopting digital processes that maybe aren't being used at the moment. Now, there are some differences though between this measure and the measure relating to training costs. While on the face of it looks pretty similar, this 20% bonus deduction, one of the main differences is this particular measure is only due to run up until 30 June 2023. So for training expenditure, there's an extra 12 months. We're up to 2024, 30 June 24. But for technology expenses, 2023 is when this is due to expire. The other main thing is that this measure is subject to an annual cap. So a $100,000 expenditure cap will be imposed. So that bonus deduction will be limited to some extent in this case, particularly for organisations that might be spending significant amounts on adopting new technology. Now, the timing rules are pretty similar though. Again, the government is suggesting that expenses incurred from budget night up until 30 June 2022, that bonus deduction will be claimed in the 2023 return. The 23 return would also be used to claim expenses incurred during the 2023 income year. So pretty much all of the bonus deductions for this particular measure, the expectation is that they'll be claimed in the 23 return. Again, there's some details that aren't quite there. The budget suggests that this could apply to not only expenses that are, I guess, revenue in nature, the sorts of things that you might claim as a normal business deduction, but potentially could apply to depreciating assets as well. It just remains to be seen how this will interact with existing depreciation rules. For example, temporary full expensing, and exactly how the timing works in terms of claiming some of those deductions. But that's some of the detail that we just don't really have at this stage.
The other issue that often comes up is the tax treatment of COVID-19 state and territory grants. Now, it's a bit of a mess whether it's non-assessable, non-exempt income, which ones are, which ones aren't. The budget did have a section on this. Michael, what can you tell us, and does it add any clarity?
Yeah, it has been a bit hard to follow in this area. Look, the starting point is if you have a client who's running a business and they've received a grant from state or territory government relating to their ongoing business activities, the default position is that's probably going to be taxable to them. It's probably going to be included in assessable income. But that's unless a specific exemption applies. We know, or a lot of us would know, that cash flow boost payments, for example, were given specific tax-free treatment. Legislation was also passed to allow certain state and territory government COVID-related grants to also have tax-free status if some basic general conditions were met. But the thing that some people are forgetting is that even if some of those general conditions are met, you don't get tax-free status for a particular payment unless the Treasurer has issued a determination, a legislative instrument, stating specifically that this particular payment can be non-assessable, non-exempt income. And that's where we end up with some slightly odd outcomes. To date, and certainly up until the end of 2021, the Treasurer had issued a few legislative instruments which only covered specific grants paid by the New South Wales and Victorian governments. And there will be clients who received a mixture. They got some grants that were tax-free and some grants that are not on that list and are therefore taxable. Well, in the budget, the government has said that some additional grants have been given tax-free status. Now, we haven't seen the legislation on that yet, although the budget suggests that it's happened. But sometimes there's a bit of a lag between some of these things kind of making it out into the public. But what the budget tells us is that some additional New South Wales, Queensland and South Australian payments potentially qualify for that tax-free status, subject to the business meeting the basic conditions in terms of turnover thresholds, etc. So look, that's good news, but it still means that not every single state government grant will be tax-free. You still need to work very carefully through the list, look exactly what it is your client has received. They may have received multiple payments over a period of time. Some of those might be on the list. They might qualify for tax-free treatment, but if they're not on the list, they're probably going to be taxable. So we need just to be very careful about that. But the budget announcement is good news because lots of businesses have received these payments and without being on the list, they're going to be taxable in most cases. So it will be good news for a lot of clients. We just need to be really careful and look at the detail.
Now, given this is an election budget and short on structural change, the question for you, Matthew, is what's missing?
To be fair, Lisa, look, the government's probably a bit too preoccupied with a couple of different unexpected things at the moment to really look at structural type tax reform. But having said that, look, I was really hoping that the budget would at least give a bit of an update or indication around some of the tax law reform proposals that have been announced in the last couple of years where things have just gone a bit silent. And one of those key areas is Div 7A. And there was a proposal, and sorry, just to step it back a bit, When a private company makes a loan to a shareholder to avoid an undeemed franked dividend, you normally put a complying loan agreement in place, and you've got the choice of either doing an unsecured 7-year loan or a secured 25-year loan. Now, the proposal that was made a couple of years ago was to basically scrap both the 7 and 25-year loan and put in place a single 10-year loan period. That was announced a couple of years ago. It's been deferred, I think, maybe just twice. And then things have just gone a bit silent. And we were really hoping that the budget would at least give an indication of whether these reforms were going ahead. Because, when you're looking at 10-year loan repayment periods, you really do need to start modelling your cash flow to see whether you can make those repayments. But no luck here, and it's still a wait and see until we hear something more.
So Matt, we've seen in the budget that the government is actively encouraging skilled workers to come and work in Australia again. I guess what we're left in a bit of limbo with, though, is where are we up to in terms of residency rules? We were told that there'd be some pretty significant changes to residency rules a little while back. Was there any mention of that in the budget, and where are things at the moment?
Look, unfortunately, Mike, the budget didn't really provide any real clarity on individual tax residency. Now, individual residency can be a pretty hard area of the tax law, especially when you're dealing with borderline cases. And a pretty good indication of that is just the number of cases that go through the courts that deal with residency issues. Now, there was a proposal recently to introduce what I'd refer to as a bright line 183-day test to determine whether someone coming into Australia was a tax resident. That's also gone silent, and unfortunately, the budget didn't really give any indication also whether that was going ahead or what's really going on with that. Look, and when you've got a budget that has the sort of overall theme of trying to encourage people to come back to Australia and join the labour force, not having some sort of clear rules or guidance around residency from a tax perspective just really does go against that theme.
And that's the roundup for March. Changes are constant in the lives of accountants and advisors. The Knowledge Shop membership can help make a difference in a very practical way. We're doing this for accountants and advisors across the country. Give us a call on 1800 800 232 or just jump onto the website and book in a time to take a tour. We'd really love to show you how we make a difference every single day. Talk to you soon.